In the last 48 months, billionaire portfolios shifted $2 trillion into physical assets. This isn't diversification, it's coordinated exit before currency repricing. We're at stage 3 of a 6-stage reserve currency liquidation. London, 1949. Sterling was the reserve currency. British elites held safe government bonds. Behind closed doors, they knew the numbers. £3.7 billion in forced loans disguised as reserves, negative real yields, and an exhausted treasury. The smart money rotated to land, gold, and dollars 24 months before the public devaluation. When sterling collapsed 30%, bondholders lost 40% in real terms overnight. Today, family offices are moving 25 to 35% of portfolios into hard assets. Normal allocation, 15%. This is the same 48-month advance signal that preceded every major currency crisis since 1945. The question isn't if the dollar reprices, it's whether you notice the Treasury auction gap before your savings lose half their purchasing power. This is stage 1, overextension. Here's why this matters to you. If you have a 401k, there's a 60% chance it holds $40,000 to $60,000 in Treasury bond funds showing stable returns while losing 3 to 5% annually in purchasing power. That's $2,000 to $3,000 vanishing every year in money you'll never see. The Treasury market is a $27 trillion lending facility where the U.S. government borrows $2 trillion annually to fund spending that exceeds tax revenue by 25%. The deal worked for 40 years because foreign exporters had no choice. They sold us goods, received dollars, and had to buy treasuries because no other market could absorb trillion-dollar flows. Picture the auction room logic. Every week, the Treasury sells new bonds. Foreign central banks show up with dollars from their trade surpluses. They bid, the auction clears. The deficit gets funded. Nobody asks whether the returns make sense. They can't. If they don't buy treasuries, their currency appreciates, their exports become unaffordable, and their economies collapse. This is vendor financing, forced lending to your customer so they can keep buying from you. China sells $400 billion in goods to the U.S. annually, accumulates dollars, then lends those dollars back by buying treasuries earning 4.5% while actual inflation runs 7%. They lose 2.5% annually, guaranteed. Now, they do it anyway because the alternative is immediate economic collapse. Let me be completely clear about the mechanism. The petrodollar covenant locked this in. In 1974, Saudi Arabia agreed to price oil exclusively in dollars in exchange for U.S. military protection. This forced every oil importer globally to hold dollar reserves. Those reserves had to go somewhere. The only market liquid enough, treasuries. The math sealed it. $90 trillion in annual global trade, 58% denominated in dollars, requires $15 to $20 trillion in working dollar reserves. Those reserves earn negative real yields. 4.5% coupon minus 7% inflation equals negative 2.5% real return. Holders lose $375 to $500 billion annually in purchasing power. This isn't a bond market, it's a tribute system. Here's what this means for you. Your Treasury bond fund shows 4.5% returns. Your brokerage statement says you made $4,500 on your $100,000 allocation. But a basket of groceries that cost $100 last year costs $107 today. Your gain bought you 2% less than when you started. Multiply that across 10 years. Your retirement account grows nominally while your actual purchasing power declines 25 to 30%. The bubble created a global addiction. Emerging markets structured entire economies around export-driven growth that required dollar reserve accumulation. Their banks, their corporations, their governments all became structurally long dollar bonds. When those bonds turn toxic, there's no easy exit. The sell pressure has to go somewhere. Odyssey, you might be thinking, treasuries are the safest investment in the world. The U.S. has never defaulted. This is where you park money during uncertainty. Here's the problem with that assumption. There are two types of default. Explicit default means refusing to pay. Implicit default means paying in currency worth 30 to 50% less. Britain didn't default in 1949. It devalued sterling 30% and called it economic adjustment. Bondholders got paid in full in pounds that bought 40% less. The U.S. will do the same. It has to. The math doesn't work otherwise. You'll get your principal back. It just won't buy what you thought it would. Britain 1945, sterling reserves totaled £3.7 billion held by Commonwealth nations, perceived as a liquid wealth equivalent to gold. These weren't savings. They were frozen vendor financing for Britain's war spending, earning 1% while inflation ran 7%, guaranteeing 6% annual wealth destruction. And that's just stage 1, the setup. Stage 2 is where the smart money reads the balance sheet and starts moving. This is stage 2, warning signals. We're entering stage 3 now. Here's why this matters to you. Billionaires have a 30-year track record of moving capital, 48 months before currency crises become public. They're moving now. You have maybe 18 to 24 months before the repricing hits your paycheck. Family offices manage $6 trillion globally. Historical allocation to hard assets, 15 to 18%. Current allocation, 25 to 35%. That's $600 billion to $1.2 trillion rotated from bonds and cash into gold, land, energy assets, and commodities in 48 months. This isn't asset class rotation, it's coordinated exit. Singapore, 2023. Private vault operators report 200 to 400% increase in institutional gold storage requests. Not retail buyers. Family offices moving $50 to $500 million positions. They're buying physical metal, taking delivery, storing offshore. These are clients with dedicated treasury desks who've held government bonds for decades. Now they're paying 1 to 2% annually in storage fees to hold metal that pays no yield. The same pattern in Wyoming and Montana. Agricultural land purchases by billionaire-backed entities. Not for development, for production. 50,000-acre ranches generating $2 to $3 million in annual cattle revenue. The math seems terrible. 2 to 3% yield on $100 million in land. But the land appreciates with currency debasement. The revenue is inflation protected, and unlike bonds, nobody can print more of it. Here's how it works. This is counterparty de-risking. Every financial asset is a claim on someone else's future payment. Bonds, government promises to pay. Stocks, corporate cash flow promises. Cash, bank promises to honor deposits. During currency stress, those promises break. Banks fail, governments devalue, corporations default. Physical assets have no counterparty. Gold is settlement final, things with no counterparty risk. When you hold it, the transaction is complete. Agricultural land produces food regardless of what happens to currency. Energy infrastructure generates commodity-linked revenue that rises with inflation. These assets don't depend on anyone keeping promises. The rotation pattern is documented. 1971, pre-gold standard end. 1979, pre-Volcker crisis. 2007, pre-financial crisis. Billionaire hard asset allocation spikes 48 months before public crisis. Current spike started 2021 to 2022. Here's what this means for you. When billionaires move, they're reading balance sheets you can't see. They have treasury desks, Fed contacts, access to auction data before it's public. They knew subprime was breaking in 2005. They knew European debt was unsustainable in 2009. They know something about Treasury-demand now. The signal is clear. Their exit creates a reflexive loop. As they sell treasuries to buy settlement final assets, auction demand weakens. Weaker demand means higher yields required to clear auctions. Higher yields mean bigger losses for remaining holders. Bigger losses accelerate the next wave of exits. Each billionaire who moves makes the next one's decision easier. You might be thinking, the wealthy always invest differently. This is just normal diversification, not a crisis signal. Here's the problem with that assumption. The velocity matters. Moving from 15 to 18% hard assets over 10 years is diversification. Moving from 15 to 30% in 48 months is crisis positioning. The data shows this pattern appears only before major currency events. It appeared before Britain's 1949 devaluation, 24-month advance. Before the 1971 gold standard collapse, 36-month advance. Before the 1994 Mexican peso crisis, 30-month advance. The pattern has a 30-year track record. The lead time is contracting. It's 48 months now. That puts public crisis at 2026 to 2027. Britain, 1947 to 1949. while Treasury officials publicly defended sterling. While the Rothschild family and major merchant banks quietly rotated £200 million to dollar assets, gold, and overseas land. The exit began 24 months before the 1949 devaluation. When sterling crashed, they were holding assets that appreciated 40% in relative terms overnight. That's stage 2, the warning. Stage 3 is where foreign treasury holders run for the exits and the Fed faces an impossible choice. This is stage 3, margin call. We're here now. Here's why this matters to you. When the Fed resumes money printing to prevent treasury auction failures, your grocery bill increases 15 to 20% in 18 months. That's $1,200 per month more for the median household. The rescue is the crisis. Foreign treasury holders are liquidating. China's holdings, down from $1.3 trillion, peaked to $775 billion today. Japan, down $150 billion from peak. Saudi Arabia, down $50 billion. Total foreign official holdings, $7.6 trillion peak, now $6.92 trillion. That's $680 billion in net selling. It's accelerating. New York, Tuesday afternoon. Primary dealer desks at JP Morgan, Goldman. Citi received the Treasury auction results. Bid to cover ratio, 2.1, weak. Foreign indirect bidding, 52%, down from 65% historical average. Dealer takedown, $42 billion, record high. This means the auction cleared, but dealers had to warehouse $42 billion themselves because foreign buyers didn't show up. Dealer balance sheet capacity is finite. They're repo financed. They can hold maybe $140 to $160 billion in inventory before regulatory capital requirements bind. They're at $125 billion now. That's $15 to $35 billion of remaining capacity. The U.S. needs to issue $600 billion more this quarter. The math breaks in 4 to 8 weeks without Fed intervention. Here's the mechanism. Primary dealers are required to bid in Treasury auctions. If natural buyers, foreign central banks, pension funds don't absorb the supply, dealers must. They warehouse the inventory, finance it overnight in repo markets, and hope to sell it before taking losses. But here's the problem. If dealers are stuck with $150 to $200 billion they can't sell, they stop bidding aggressively. The next auction requires higher yields to clear. Higher yields mean mark-to-market losses on existing inventory. Losses constrain their capital. Constrained capital means less ability to support the next auction. This is the doom loop. And the Fed's only option, resume balance sheet expansion, buying treasuries directly to fill the demand gap. Call it QE, call it yield curve control, call it temporary technical operations. It's monetization. The Fed prints money to buy bonds nobody else wants. Scale required, $300 to $500 billion over 6 to 12 months just to stabilize. If foreign selling continues, $1 to $2 trillion over 24 months. That's 8 to 10% money supply growth annually on top of an already inflated base. Here's what this means for you. The money doesn't disappear, it floods into the economy. M2 money supply grows 10 to 15%. That 10 to 15% dilutes every dollar you hold. Your paycheck might get a 3% raise. Prices rise 10%. You're losing 7% annually in purchasing power. Your $60,000 salary becomes $55,800 in real terms. Your $500,000 retirement account becomes $465,000 in real terms, every year, compounding. Mortgage rates spike first. Treasury yields control all borrowing costs. If 10-year yields jump from 4.5 to 6%, required to attract buyers without Fed support, 30-year mortgages go from 7 to 8.5 or 9%. That's $450 to $600 per month more on a $400,000 loan. Housing demand collapses. Home values drop 15 to 25%. Your equity evaporates. You can't refinance because you're underwater. You might be thinking, the Fed has unlimited capacity to support the Treasury market. They proved this in 2020. They can do it again without consequences. Here's the problem with that assumption. In 2020, the Fed expanded its balance sheet by $3 trillion while the economy was locked down. Demand was suppressed. Inflation stayed low temporarily because nobody could spend. Today, the economy is open. Labor markets are tight. Supply chains are constrained. If the Fed prints $2 trillion now, it hits an economy already running inflation at 7%. That doesn't produce 2020's temporary stability. It produces 1970s stagflation or 1920s Weimar acceleration. The context changed. The playbook doesn't work anymore. Now we have to address the elephant in the room, the critical vulnerability. If the Fed monetizes, it announces insolvency. Markets understand the only buyer is the printer. That revelation accelerates foreign exit, corporate dollar debt refinancing panic, and consumer inflation expectations unanchoring. Off the rescue triggers the cascade it's meant to prevent. Britain, 1947. Chancellor Stafford Cripps announced austerity to avoid devaluation. Spending cuts, tax hikes, wage freezes. The plan was to restore confidence without printing money. It failed within 18 months. By 1949, Britain had to devalue anyway and had lost 2 years where the wealthy could have preserved wealth through early exit. The US is attempting the same failed playbook now. That's stage 3, the forced choice. Stage 4 is where the currency repricing begins and physical assets become the only purchasing power defense strategy. This is stage 4, asset stripping. Here's why this matters to you. When currency repricing hits, imports spike 30 to 50% in price overnight. Gas goes to $7 per gallon. Electronics double. Prescription drugs become unaffordable. This isn't inflation, it's your currency buying half as much globally. The dollar doesn't collapse, it reprices. Historical range for reserve currency resets, 30 to 50% devaluation over 18 to 36 months. Britain's sterling lost 30% in 1949, another 15% by 1967. The process took 18 years. Today's interconnected markets compress the timeline to 24 to 36 months. Dubai, 2025. Chinese state-owned enterprises are negotiating commodity contracts in yuan, not dollars. Saudi Arabia accepts yuan for 15% of oil sales to China. Russia and India trade in rupees. Brazil and China settle in local currencies. These aren't headlines. They're contract terms being executed now. Every bilateral deal bypassing the dollar reduces global reserve requirements. If global trade needs 10% less dollar reserves, that's $1.5 to $2 trillion in excess Treasury holdings with no natural buyer. Those holdings hit the market. The sale pressure compounds the auction gap. The repricing accelerates. Let me be completely clear about how currency repricing follows a pattern. First, foreign official holders reduce accumulation, happened 2020 to 2022. Second, they rotate reserves from treasuries to gold and commodities, happening now. Central bank gold purchases at 50-year highs. Third, they reduce existing holdings, starting now. Foreign sales at $200 to $300 billion annually. Fourth, private capital flees, coming next, once retail sees billionaire moves. The trigger is import price shock. When the dollar loses 30% of its external value, anything America imports costs 40 to 50% more domestically. Exchange rate plus supply chain costs. Oil, electronics, pharmaceuticals, clothing, machinery. The U.S. imports $3.8 trillion annually. A 40% price increase is $1.5 trillion in additional costs flowing through to consumers. Here's what this means for you. Your $50,000 sedan now costs $70,000. Your $1,200 iPhone becomes $1,800. Your $150 monthly prescription drugs become $225. Your $4 per gallon gas becomes $6 to $7. Your $300 weekly grocery bill becomes $450. This happens over 24 months. Your salary adjusts maybe 15% if you're lucky. You're losing 25% of your purchasing power. Retirement accounts, holding bonds get destroyed. A 30% dollar devaluation plus 10% inflation over 3 years means 40% purchasing power loss. Your $500,000 401k becomes worth $300,000 in real terms. The statement still says $500,000. You just can't buy what you thought you could. Meanwhile, those who rotated to agricultural land, gold, energy assets see their positions appreciate 40 to 60% in relative terms. The wealth transfer is generational. You might be thinking, the US is still the largest economy. The dollar won't collapse. This is fear-mongering. Here's the problem with that assumption. Reserve currency loss doesn't require economic collapse. Britain was still a major economy in 1949 when sterling lost reserve status. They had industry, trade, military capacity. Didn't matter. The debt was unsustainable. The yields were inadequate. Foreign holders exited. The currency repriced. Our being strong doesn't prevent repricing when the balance sheet breaks. The US debt to GDP is 123%. Interest costs are $1.1 trillion annually, more than defense spending. Here, the trajectory is unsustainable regardless of economic size. Britain, 1949 to 1951. Post-devaluation. British government sold national assets to raise hard currency. Coal mines privatized. Overseas holdings liquidated. Gold reserves sold at bottom. Meanwhile, families who'd moved to land and gold saw wealth increase 40 to 60% in relative terms. The gap between those who repositioned and those who didn't determined generational wealth outcomes. That's stage 4, the repricing. Stage 5 is where we see the final balance sheet and assess the generational wealth transfer. This is stage 5, balance sheet. Now here's why this matters to you. After currency repricing, you live with the consequences for 10 to 15 years. Your retirement gets pushed back. Your kids' college costs double. Your standard of living declines 25 to 30% and doesn't recover in your working lifetime. Post-crisis dollar settles at 30 to 40% lower purchasing power. This becomes the new baseline. Bondholders took 40 to 60% real losses. Holders of physical assets preserved wealth or gained in relative terms. The gap creates permanent wealth stratification. Those who understood the signal moved early. Those who didn't lost decades of savings. Washington, 2028. Congressional hearings investigate why didn't anyone warn us? Treasury secretaries explain, we issued warnings. We called for fiscal discipline. Markets didn't respond. What they don't say, they issued warnings in language designed to be ignored while their families and friends rotated capital to safety. The balance sheet reality, $36 trillion in debt, inflated away at 10 to 15% annually for 3 years. Real value reduced to $24 to $27 trillion. Bondholders lost $9 to $12 trillion. That wealth didn't disappear. It transferred to holders of physical assets that appreciated with currency debasement. Bottom line, this is how sovereign debt restructuring works when default is politically impossible. You don't refuse to pay, you pay in devalued currency. Britain did it 1945 to 1976. Bondholders got 100 cents on the pound. Those pounds bought 30% of what they used to. Lawful repayment, complete wealth destruction. The US will follow the same path. Every Treasury bond gets paid in full, in dollars worth 60 to 70% of what they were. Mathematically identical to 30 to 40% haircut, legally clean, politically defensible as market adjustment rather than default. Here's what this means for you. Your retirement account statement still shows $500,000. But the basket of goods it buys is what $300,000 to $350,000 bought before the crisis. You work 5 to 7 years longer than planned. You delay healthcare spending. You can't help your kids with housing down payments. Your international travel becomes unaffordable. This is your financial reality for the remainder of your working life. The wealth gap explodes. Those who held settlement final assets saw values rise 40 to 60% in relative terms during the crisis. Those who held bonds lost 40 to 60%. And that's a 100-point spread in wealth outcomes from a single positioning decision made 48 to 60 months in advance. Generational wealth either preserved or destroyed based on reading the signal correctly. You might be thinking, this is too extreme. Markets will stabilize. We'll recover. Here's the problem with that assumption. Recovery means returning to current purchasing power. That takes 10 to 15 years minimum based on every historical currency crisis. Britain took 30 years to partially recover from 1949. The timeline doesn't compress just because you need it to. The math is mechanical. The wealth destruction is permanent for most holders. Britain, 1967 to 1976. Final sterling devaluation to $2.40, then $1.80. Reserve status gone. IMF austerity imposed. Decade of stagflation. But families who'd rotated to land and hard assets in 1947 preserved generational wealth. Those who held sterling bonds lost 60 to 70%, of purchasing power over 30 years. The pattern determines century-long family outcomes. That's the balance sheet. The pattern is complete. The question now is which side of the wealth transfer you're on. 6 stages. Britain took 30 years to complete them. Today's timeline is compressing to 36 months. We're at stage 3. Foreign treasury holders are exiting. Primary dealers are maxed. The Fed will restart printing within 6 to 12 months. Billionaires positioned 48 months ago. They're at 25 to 35% hard asset allocation now. You have maybe 18 to 24 months before currency repricing hits consumer prices. The pattern has a 75-year track record. The signal is clear. The balance sheet math doesn't work. The question isn't whether the repricing happens. It's whether you reposition before your purchasing power drops 30 to 40% and doesn't recover in your lifetime.